Now, what are the cyclical factors or short-term factors? First is overvalued exchange rate. So we will discuss the concept of exchange rate, what is the meaning of overvaluation, undervaluation separately. However, here you just understand that overvaluation of export, overvaluation of exchange rate, it has adverse impact that it makes our exports expensive. So our exports become more costly in the world market, and it makes the import cheaper. It makes the import cheaper. So it increases the import and decreases the export. Overall, it has a negative impact. Boom in the domestic demand. This is also very important reason. So in India, we are seeing that population is increasing. We have demand or consumption oriented growth. Because of this demand or consumption led growth, there is a lot of consumption happening inside the domestic country only. Therefore, there is no requirement of export itself. So exports are reduced because the entire consumption, the entire production is consumed in the country only. Recession in the key export market. So this is there. So after the 2008 financial crisis, there was huge recession in the countries like USA, European countries and other developed Western countries. Because of that, the exports get reduced. Slump in the global prices of export. This is also possible. Increase in the demand of imported technology. So we are a developing country and we need more and more technology. So because of that, the imported technology becomes more and our imports gets increased. Now what are the causes of current account surplus? So this is just opposite. First of all, there is surplus of saving and investment. So the savings rate is good, investment is good. Second, significant long run competitive advantage. There is a possibility of long run competitive advantage. For example, if we talk about India, in India we have a advantage in the form of demographic dividend. So we have a advantage in the form of demographic dividend. Our working age population is increasing and dependent population is decreasing, right? So this demographic dividend, it can provide us long run competitive advantage as compared to the other countries like Japan, China and other countries. Long run rise in the global prices of main exports. Structural increase in the net investment income. Trend rise in the factory productivity. Then what are the cyclical factors? Depreciation in the exchange rate. Depreciation in the exchange rate has a positive impact because it makes our export competitive. It makes our exports competitive and it makes our imports costly. So it reduces the import and increases the export. Strong consumer demand in key export markets. Strong consumer demand in key export markets. Cyclical improvement in the terms of trade. So terms of trade basically means that we are having more bargaining power because of certain unique things that we may be having. Fall in the prices of imported energy or component. So this is possible when the crude oil prices are declining. So for example, in India in 2016-17 the crude oil prices declined and because of that this fall in prices were there. Rise in the net inflow of remittances or profit. This is also possible. So these are the different possible reasons of the current account surplus. Now coming back, we have discussed the current account, right? We have discussed the current account. Now we will discuss the capital account. So capital account records all the international transactions that involve the resident of a country concerned changing either his assets with or his liabilities too. So here the main aspect is that there is an impact over the asset and or liability, right? Transactions in the capital account reflect a change in the stock. Change in the stock, either assets or liabilities. This is very, very crucial. So either it will involve the capital like loan or equity, right? Or it will involve the change in the NRI deposit in the banking system, etc. It is a difference between the receipt and payment on account of capital account. It refers to all the financial transactions which happen on the capital account. The capital account involves inflows and outflows relating to investment. So it will cover the transaction like investment, short-term borrowings or lending, medium to long-term borrowing or lending. So all the transactions in the form of borrowing, lending, investment, FII, FDI, ECB, bank credit, all these are covered in the capital account transactions. So now here you can see capital account transactions are a two-way and multiple transactions, right? So two-way means that first there will be receipt of the loan and then it will be repaid, right? So one example is the loan, right? Capital account balance, how do we determine? First item is the external assistance. This is basically the loan taken by the government, right, from the bilateral and multilateral agencies. Bilateral means from some other country, multilateral means from some other group of countries like SAARC, it may be World Bank, it can be IMF, it can be any other organization. So first item is the external assistance or the government loan. Then external commercial borrowing. So this is the commercial borrowing. This is taken for the business purposes. It can be in the form of bank credit, suppliers credit, buyers credit, etc. Non-resident deposit. So the non-resident Indians, when they are depositing the money into the bank accounts of India, so that is called non-resident deposit. Foreign investment, it can be in the form of FDI, direct investment, or it can be in the form of FPI, foreign portfolio investment, and other flows. So external assistance means transactions of official government, bilateral and multilateral loans. External commercial borrowing means commercial loans availed from non-resident lenders. Commercial borrowing means loan transaction by the commercial enterprise. Non-resident deposit means deposit received from the non-resident Indians. Foreign investment, it can be either in the form of foreign investment, FDI or FPI. Now other flows. Other flows include, what are the other flows in the capital account? Delayed export receipts, leads and lag in the receipt of export, funds held abroad, and other capital transactions not included elsewhere, right? So if the exports receipt are delayed, so that becomes basically the asset because that amount is due to us but we have not received it. So last year it might have come in the current account, but because this was pending, therefore this becomes part of the capital account. If the capital account balance is positive, then we call it favorable capital account balance. If the capital account balance is negative, then it is called unfavorable capital account balance. So this is again the statement of balance of payment which I have taken from the economic survey. I am again showing you so that you can see that whatever we have covered is from this statement only. So we have covered export, import, trade balance. In the invisible we have covered services, income transfer. In the capital account we have covered ECB, external assistance, short-term credit, banking capital, NRI deposit, FDI, FII, FPI, right, and other flows. So we have covered till now. Now we will see the difference between the capital account and the current account. So to make this difference more clear, let me show you in a brief the difference between the current account and the capital account. So current account is the representation of the trade balance. Trade balance. So this is concerned more about trade, right? Capital account is the representation of capital investment and expenditure. So this is more concerned about the investment part. This is more concerned about the trade part. This is more concerned about the investment part. So this is more concerned about the import and export. This is more concerned about the investment of capital. Second, how do we measure the fund inflows and outflow of international trade? So it measures that how much is the international trade. It measures how much is the capital being invested in the international so that the international trade can increase. When there will be more capital invested into into the different countries, then definitely the trade will increase. Next, the effect changes in. So what is the impact of current account? It impacts the net income. So as I already told you, current account impacts the income and expenditure. What is the impact of capital account? It impacts the financial account, or it impacts the balance sheet. Deals with. So it deals with trade receipts and it deals with the capital receipts. Balance of payment. What is the impact? Current account is one component of the balance of payment, and this is also another component of the balance of payment, right? So in this case there is a similarity. Now we have discussed current account, we have discussed capital account. Now let us see the fourth portion, that is error and omission. This is reserve account, we will be discussing separately. So errors and omission, it means the difference between the debit and credit entries of all transactions. So debit basically signifies the outflow and credit signifies inflow. We have discussed this point earlier also. As data compiled in double entry book keeping is from various sources, right? So the data that we have to take for calculating this export, import, everything, that data is taken from a lot of sources. And there are chances of mismatch. So this mismatch is converted into match through error and omission. So the balancing figure is actually put into the error and omission. So error and omissions, the entries under this head relate mainly to leads and lags in the reporting of transaction. So either the transaction will be reported earlier or it will be reported with a delay. So in both the cases, this will become part of the error and omission. It is of balancing entry. So this is a balancing entry. And is needed to offset the overstated or understated components. Overall balance, it is a sum of current account balance and the capital account balance, right? So overall balance here means the BOP balance. So whether the BOP balance is the surplus or deficit. So it is the sum of current account balance and capital account balance. Balance of payment is equal to current account balance plus capital account balance plus errors and omission. If the balance of payment is surplus, it is added to the foreign exchange reserve, right? So surplus balance of payment means the receipt of foreign exchange is more than the payment of foreign exchange. So definitely the foreign exchange that we have in the country, the stock of foreign exchange will increase. If the balance of payment is in deficit, that means there will be deduction in the foreign exchange reserve. So in this case, the payment of foreign exchange is more than the receipt of foreign exchange. So definitely this will result into the reduction of the reduction of the foreign exchange reserve. Disequilibrium in the balance of payment. So disequilibrium means it can be either in the form of surplus or deficit. A surplus in the BOP occurs when total receipts exceed the total payment. So BOP in here, credit is more than debit. So this is BOP surplus. So friends, I am repeating the same thing from different perspectives so that in examination you find any type of question and you can solve that. A deficit in the BOP occurs when total payment exceeds the total receipt. So here this is basically BOP deficit. Now the difference between the BOP deficit and the BOP surplus. BOP deficit, the country imports more goods and services and capital than its export. So import is more than export. This is what is reflected by the BOP deficit. It must borrow from other countries to pay for its import. Definitely, if the import is more than export, definitely either the foreign exchange reserve stock will decrease or it will have to borrow from the foreign country. In the short term, this fuels economic growth, right? Because there is import and this import leads to the consumption, and also at times it also increases the technology. So this can lead to the economic growth in the short term, but in the long term it will have to go into debt to pay for the consumption. So in the long term we may have to take the loan to repay this amount. BOP surplus, that means the country's exports are more than its imports. Country provides enough capital to pay for all domestic production. A surplus boosts economic growth in the short term. In the long term it becomes too dependent on the export driven growth. So this happened in case of China. So China was largely dependent upon the exports for its growth, and because of the over dependence upon the export, when there was a financial crisis in the world, China was the first country to get impacted. Now, India's balance of payment. So as I already told you that the country like India, which is a developing country, the BOP deficit is bound to be there. So in a country like India, which is on the path of development, generally experiences the deficit balance of payment situation. This is because, so why is this happening? Because such a country requires imported machines, technology and capital equipments in order to successfully launch and carry out the programs of industrialization. Now, what are the reasons for the deficit balance in India? What have been the reasons for deficit balance in India? So normally in India there is a balance of payment in the deficit format. Why? Because first, so here I would like to tell you that in 1990 and 1991 there was a huge balance of payment crisis. India was not having the sufficient fund to pay for the 2 weeks import, right? So at that time there was a huge BOP crisis. Now what was the reason for the BOP crisis? First of all, the government liberalized imports in 1985, right? So as I told you in the starting of the session itself, that India used to be a closed economy till 1991, right? But in 1985, the imports were liberalized to some extent. Because of that, the imports increased a lot and we did not have the sufficient amount to pay for the import. That is why this balance of payment crisis happened. Second, there was Gulf War. Because of the Gulf War in 1991, the crude oil prices increased. Then there was rapid industrialization. So India was on the path of industrialization after the 1991. We liberalized and privatized our industries. Because of that, there was huge import of capital goods and the technology. The invisibles were slow in growth because our country was not having the skilled manpower. Then there was devaluation and depreciation of rupee against the importing countries. Finally, in 1991, the crisis happened and even the exports have been less. So all these are the reasons for the historical deficit balance in India. So here you can see this figure which I have taken from the economic survey, India's share in the world exports. So in 2011, almost 10 years ago, this India's share in the export was 1.64% of the world trade. In 2018, it remains same. So in between it has been fluctuating. It went down till 1.57% and a maximum 1.78%. This is a very shameful thing because in India we have the population of approximately 16-17% of the world population, but this export is just less than 2% of the world export. This is a very, very poor situation. Now top 10 export destinations in 2011-12 and 19-20. Again, this figure I have taken from the latest economic survey. So the top 10 export destinations, the first destination is USA and the second destination is UAE and the third destination is China. You just need to remember these three names, nothing else. So this is a very factual diagram. Commodity wise composition of export. So highest export belongs to the petroleum products, second highest belongs to the pearl, precious stone and semi-precious stones. So this is true both for the 2011-12 and 2019-20. In both the cases, petroleum products is the highest export, and pearl, precious stone and semi precious stone is the second highest item. Now, reasons for poor performance of India's export trade. Why India's exports have been poor? First of all, the high prices. So our prices are high because of the high documentation formalities, high transaction cost, and also because we want to make the high profit on the export. So as I told you, our logistics cost is approximately 13% to 14% of GDP as compared to the average 10% and 9% in the other countries of the world. Poor quality. Many Indian exporters do not give much importance to quality control. So their products are poor quality, and due to poor quality they are rejected. So this rejection of export consignment is a very natural phenomena. Poor negotiation skill. So Indian exporters, they lack negotiation skill, and because of that, because they are poor trained in the marketing, right? So everyone is an engineer. Every engineer wants to become the businessman. They don't have the training in the marketing. They fail to convince and induce the foreign buyer to place the orders. Because of that, we are not able to get much of the export orders. Inadequate promotion. For export marketing, promotion is important. Many Indian exports do not give much importance to promotion. A good number of Indian exporters are not professional in advertising and sales promotion. They do not take part in the trade fairs and the exhibitions. So this trade fair, exhibition, all these things are very, very important if we want to promote our country. Poor follow-up of sales. This is also very much there. We don't believe in providing the post-sale services. Because of that, our country's products are not much in demand. There are other reasons. First, we have the good domestic market also. So our population is increasing. We are a developing country. Therefore, the consumption is there. We are consuming more. Our income is increasing. So our purchasing power is also increasing, and because of that, domestic demand is increasing. Therefore, the exports are not increasing. Then there are a lot of formalities which happen over there. Problem of trading blocks. So the trading blocks, they reduce the trade barriers on member nations, but they impose trade barriers on non-members. And India is not a member of most of the trading blocks. So this actually impacts the India's export. Negative attitude. Some of the overseas buyers have a negative attitude towards Indian goods. They feel that Indian goods are inferior goods. So there is a general tendency that the quality of Indian goods is not poor. Because of that, their attitude is built up. Then India's infrastructure is poor. For the Indian exporter, it is very, very difficult to deliver the orders on time. Our port quality, the turnaround time of the ships, everything is very, very poor. Now, what are the causes of disequilibrium in the BOP? Cyclical fluctuation, shortfall in the exports, economic development. So because of the economic development, we are more in the import mode than in the export mode. Rapid increase in the population. This is also very, very important. Structural changes, natural calamities. So there is a lot of natural calamities happening, and international capital movement. Now, what can be the measures to control to disequilibrium of the BOP? How we can control the BOP deficit? First of all, what are the monetary measures? In the monetary measure, first is the monetary policy. How this monetary policy can impact? So basically, if we want to increase the export, the one way to increase the export is to reduce the prices of goods. How the prices of goods can be reduced? To decrease the prices, we have to basically control the inflation level. The inflation level can be controlled by the RBI. Therefore, this monetary policy, the monetary policy is a concern with money supply. So this can control the money supply and carry it in the economy. The central bank may expand or contract the money supply in the economy through appropriate measures which will affect the prices. And if the prices are decreased, our export become competitive and we can increase the export and BOP can be controlled. BOP deficit can be controlled. Then fiscal policy. Fiscal policy is government policy on income and expenditure. Government incurs development and development expenditure. It gets income through taxation and non-taxation resources. Depending upon the situation, government expenditure can be increased or decreased, right? So in case there is a huge loan the government is taking for more and more expenditure, in that case the government can reduce the expenditure and control the loan it takes from the outside countries. So even the fiscal policy can impact the BOP deficit. So you can see that this monetary policy and fiscal policy are interlinked with the foreign or external policy. Then exchange rate depreciation. So as I told you, we will discuss more about the exchange rate in detail separately, but here I will be just touching this exchange rate depreciation concept and the impact. So exchange rate depreciation, what is the impact of exchange rate depreciation? Because of this, the value of import or the cost of import, it increases and the export prices gets decreased. So this is the impact, right? So this is a very positive aspect. Because of that, the import decreases and export increases, right? By reducing the value of domestic currency, government can correct the disequilibrium in the BOP in the economy. Exchange rate depreciation reduces the value of home currency in relation to foreign currency. As a result, import becomes costlier and export becomes cheaper. It also leads to inflationary trends in the economy. But this is a very, very poor aspect, that it leads to the inflationary trend. Devaluation. So when the government devalues the currency officially through the active intervention, then the impact remains same. So depreciation happens through the market forces and devaluation happens through the active intervention of the monetary authority. Deflation can also decrease the prices. Deflation means decrease in the prices. So even the deflation can lead to increase in the export. Exchange control. So even the exporters, they can be directed by the monetary authority to surrender their foreign exchange earning. So when foreign exchange earning are deposited with the RBI, then they will not be used to buy the imported goods. Now, what are the non-monetary measures? So till now we have discussed the monetary measure. In the monetary measure, we have discussed monetary policy, we have discussed fiscal policy, right? And we have discussed exchange rate depreciation, we have discussed devaluation, we have discussed deflation, and we have discussed exchange control. Now what are the non-monetary measures? In the non-monetary measure, first we should increase the export. How this can be increased? We can reduce the export duty. Duty basically means the taxes, right? So if the taxes are decreased, then the prices of exports will decrease and the competitiveness will increase and the demand for the export goods will increase. Cash assistance and subsidies can be given to the exporters to increase the export. Goods meant for export can be exempted from all type of taxes, right? So this basically represent the taxes the government levies should be decreased. Second, import substitution. Steps may be taken to increase the production of imported substitute. This will save the foreign exchange in short run by replacing the use of import by these import substitute. So as much as possible, we should observe those items which are much in demand and we should establish the manufacturing facility. The government has undertaken the project of Make in India to ensure that import is substituted. Import control should also be there, right? For import control, there are two systems possible. One is quota system, another is tariff system. Please understand this system. These are some of the unique concepts which I have not discussed so far. So please be careful. Quota basically represent some limitation, right? Some quantitative limitation. So under the quota system, the government may fix and permit the maximum quantity or value of a commodity to be imported during a given period. By restricting import through the quota system, the deficit is reduced and the balance of payment position is improved. So government can say that not more than 1 crore mobile can be imported in 1 year, or not more than 100 crores can be spent for buying the mobile phone chargers. So this is how the quota system works. Tariffs means the duties. So that on the import, the duties can be increased. On the export, the duties can be decreased. Tariffs are duties or taxes imposed on import. When tariffs are imposed, the prices of imports will decrease to the extent of tariff. The increased prices will reduce the demand for the imported goods and at the same time induce the domestic producers to produce more of import substitutes. So we have discussed current account, we have discussed capital account, and we have discussed errors and omissions. Reserve account we will discuss in the separate and next lesson. With this, I complete this session. I hope that you enjoyed this session. This was little bit long session, but this was very informative also.